great debate. Futures or Forex? We are settling this today. Well, probably not settling it, but we are talking about it.
We are definitely not settling it.
Okay, fair. But we have to talk about it because last year, global payouts for futures prop firms alone exceeded $325 million.
Which is just a massive number.
$325 million. It's huge. I'm Ken, head of content here, and welcome to episode 27 of the Join Prop podcast. We are doing a deep dive today.
And I'm Jessica, freelance podcaster and the designated skeptic for the next hour or so.
Which you are going to need to be. Because, okay, we are looking at these massive, sometimes completely absurd payout differences between futures and Forex prop firms. And the data we pulled this morning is wild.
It's a lot.
It is. We have to unpack the data fees and the withdrawal friction, the leverage traps, all the hidden stuff they bury in the fine print.
Okay, hold on. Let's frame this for the people actually listening before we get into the weeds of the fine print. Because if you are sitting there right now, maybe you're in your late 20s, early fieldies, and you've been looking to get funded, but you just haven't pulled the trigger yet, this deep dive is for you.
Exactly.
We need to actually look at the mechanics of these firms before you throw your money at the screen, because a lot of this marketing is just very aggressive.
It is aggressive because that $325 million payout figure, it sounds incredible on a billboard, and the profit splits they advertise are insane.
Yeah, they really are.
Like most of these firms are hitting 80 to 90% profit splits in favor of the trader.
Right.
And some of them even scaled to 100% initially. Like Apex Trader Funding, for instance, offers 100% of the first $25,000 earned per account, and then it drops to a 90-10 split.
Wait, that's literally their business model?
Yes, you keep the first 25 grand.
That feels like a scam.
It's not a scam.
I'm not saying illegal, I'm saying it feels like one. Structurally, how on earth does a business survive by giving away 100% of the money? Just think about the math for a second.
I know it sounds...
If they are paying out $325 million globally and giving away 100% of the first $25K to the trader, where is the firm making its money? They have to be banking on everyone failing.
Okay, let's walk through how that actually works. It isn't that they sit in a dark room actively hoping you fail.
I mean, they kind of do.
They just rely on the law of large numbers. If a prop firm is offering you 100% of the first 25K, they have mountains of historical data showing them that a massive, massive chunk of people will never even get close to that payout.
So they are funding that $325 million payout with the challenge fees of thousands of failed accounts.
Pretty much.
Do we know how many people actually get that 25K?
We don't have the exact internal fail rates for every firm.
Yeah.
But if you reverse engineer it, look, the top tier guys are walking away with the lion's share of that $325 million.
Right.
For the math to work, for the firm to pay server costs, pay their staff, and still turn a profit while giving away 100% of early earnings, the underlying failure rate has to be in the high 80s or 90s percentage-wise.
90%. 90, I need a second.
Yeah.
9 out of 10 people are just throwing their money into a furnace so the one guy at the top can get his 100% split.
But that is exactly why we are having this debate today. Because it's not just futures operating this way. Forex has these massive draws too.
Okay.
Forex splits are also sitting right at that 80 to 90% mark. So both sides are playing this game.
Who is actually winning these payouts, though? If 90% of people are failing out of the challenges entirely, this sounds less like trading and more like a casino.
It's not a casino if you understand the underlying mechanics of what you're trading.
But 90%?
I know, but this is where the data gets really revealing. There is a massive difference in survival rates between the two markets.
What's the difference?
Futures traders have a median win rate of 63%.
Okay.
Forex traders have a median win rate of 50%.
50% for Forex.
Yep.
That is a coin flip. You are quite literally just guessing heads or tails.
Well, it's not guessing. It's about the leverage. The reason futures traders survive longer and maintain that 63% win rate is because their leverage is strictly capped.
How cap?
In futures, leverage is usually capped around 1.10. In Forex, prop firms will routinely let you go up to 1.50.
You're throwing out ratios, and if I'm a beginner listening to this, 1.50 just sounds like a neat number. What does that actually do to my money? We need to explain this without the finance jargon.
Okay. Let's look at it like driving a car.
Okay.
If you're in futures with 1.10 leverage, it's like driving a car at 10 miles an hour. You have control. But in Forex, with 1.50 leverage, it's like, I don't know, driving a rocket ship at 150 miles an hour on a wet road, but the steering wheel is.
Yeah.
Actually, wait, no, that doesn't make sense.
You completely lost me.
Okay, let me back up. Let me try a magnifying glass.
Let's stick to the car. You're saying Forex is like giving a teenager a Ferrari on black ice?
Yes, exactly. Because the leverage amplifies everything. If you have $100 and you are trading futures with 1.10 leverage, you control $1,000 worth of an asset.
Okay, I'm with you.
But in Forex, with 1.50 leverage, your $100 controls $5,000.
Which sounds great on paper. I have way more buying power. I can make more money. So why is the win rate lower?
Because that 1.50 leverage amplifies your losses just as fast. The market is volatile, right? It shakes.
Yeah.
And if it moves against you by even a tiny fraction of a percent, that massive leverage instantly burns through your original $100.
Oh, wow.
It wipes it out in seconds.
Yeah.
And then the firm automatically closes your account to protect themselves.
So they give you enough rope to hang yourself.
Exactly. That is why Forex traders have a 50% win rate.
Yeah.
They over-leverage, the market twitches, and the account is blown.
Jeez.
Futures caps the leverage at 1.10, so you physically cannot bring your account down that fast. You survive longer.
So these Forex firms are intentionally handing you a 1.50 multiplier, fully aware that you're probably going to flinch and burn your account.
Basically.
And then they pocket your challenge fee.
Yes, but we have to look at what those challenge fees actually are, because this is where the debate gets really complicated.
How much are they?
A futures challenge might cost you anywhere from $35 to $550, depending on the account size you want.
Okay.
A Forex challenge could be as cheap as $26. $26 to try and get funded.
$26. I spend more than that on lunch. That is almost suspiciously low.
That is the hook. But here is the reality check I found in the research, and I think this changes the entire conversation.
Bring it on me.
We need to talk about total cost of funding, or TCF, because the ongoing hidden costs in futures are brutal. Futures data fees alone cost $116 to $135 per month.
Per month. Every single month you are trading.
Every month. Withdrawal fees across both markets are roughly $10, which is whatever. But futures traders face significantly higher ongoing platform expenses just to look at the market data.
Let me do the math on this to see if I understand.
Go ahead.
I see an ad for a Forex firm. It says $26 to start. I see an ad for a futures firm. Maybe it's $35.
Right.
I think, okay, they're roughly the same barrier to entry, but you are telling me that to trade futures, I have to pay $135 every single month just to see the charts.
Yes. You have to pay for the data feed.
Why? Why do I have to pay for it in futures but not in Forex?
Because futures are traded on centralized exchanges. Think of the CME, the Chicago Mercantile Exchange.
Okay.
It is a massive central hub. Every single order goes through their servers. Because it's a central hub, everyone sees the exact same price and the exact same volume at the exact same time.
Right. That makes sense.
The CME spends millions maintaining that infrastructure, and they charge you for access to that real-time data. It's unavoidable.
And Forex?
Forex is decentralized. There is no central exchange. You are trading through a broker or a network of banks.
Oh, I see.
Because there's no single central tape, there's no central entity charging you a massive monthly fee for the data. The broker just makes their money by slightly widening the spread, the difference between the buy and sell price. So you don't have that $135 monthly bill.
This completely flips the narrative.
It does.
You just talked about how 90% of people fail. So let's look at the actual math of failing.
Okay, let's do it.
Say you are an unfunded trader trying to pass a futures challenge. It takes you 3 months. You haven't made a single dime in profit yet.
Right, you're just grinding.
You paid $35 for the challenge, but you've also paid $135 a month for 3 months just for the data. That is over $400. $400 just for the privilege of looking at a screen while you fail a $35 challenge.
And when you look at it cumulatively, it is a significant drain. But it's just the cost of doing business.
It is a massive trap. It's the total cost of funding trap. If a futures trader fails for 6 months straight, they aren't just out a few cheap challenge fees. They are bleeding hundreds and hundreds of dollars in exchange data fees.
But the firms aren't hiding the data fees. It's standard across the entire futures industry.
They might not be lying about it, but they are absolutely obfuscating it. They put the $35 challenge fee in giant neon letters on the homepage, and the $135 monthly data fee is buried in an FAQ section on page 4. You know they do.
I mean, marketing is marketing.
That is exactly why Forex attracts so many beginners. $26, 0 monthly data fees, boom, you are trading.
I agree the barrier to entry is lower in Forex. But we have to look at the other end of the spectrum, the earning ceiling. because you generally get what you pay for.
Lay the numbers on me. What's the ceiling?
Let's look at entry-level traders first. You pass your challenge, you navigate the rules, and you are just starting to pull consistent profits.
Okay.
In futures, entry-level traders are making about $4,700 to $8,700 a month.
Not bad.
In Forex, it is roughly the same, maybe slightly lower on the bottom end, around $5,000 to $8,300 a month. So at the entry level, it's a wash. The markets pay about the same.
Which makes sense. A beginner is a beginner.
Right. But here's where the ceiling completely fractures. Experienced futures traders, the top tier, are pulling in $15,400 or more per month. That is exceeding $185,000 annually.
Which is a fantastic living.
It is. But experienced Forex traders, they hit $16,700 to $25,000 plus per month.
Oh.
Yes. 25 grand a month in Forex. That is a $300,000 a year run rate. So if we're sitting here arguing about a $135 data fee, we are making the forest for the trees. Forex has a vastly higher ceiling.
You are just staring at the shiny top number.
It's a very big number.
What happens when you factor in the actual mechanisms required to hit that number? You literally just told me that Forex traders have a 50% win rate because of the 1.50 leverage trap. So how many of them are actually surviving long enough to see $25,000 a month?
The top-tier talent isn't operating at a median 50% win rate. If you are making $25K a month, you are elite. You know how to handle the leverage.
But the listener is likely median right now. You cannot sell people on the top 1% outcome and ignore the structural trap that slaughters the other 99%.
I'm not ignoring it. I'm just...
If you hand someone 1.50 leverage, almost nobody is hitting that 25K ceiling. You are taking the bait. You are pointing at a lottery jackpot and saying, look at how much money you can make. The lottery is clearly the better investment.
Trading isn't a lottery. It is a skill-based profession.
I am not saying trading is a lottery. I am saying the marketing of that 25K ceiling functions exactly like a lottery jackpot.
Well,
It is structurally designed to wash you out before you get there. You are completely ignoring the friction of actually getting that money into your bank account. Do these Forex traders just click a button and 25 grand magically shows up?
no, they don't. And that leads perfectly into the net payout twist.
I knew there was a catch.
We need to talk about the actual friction of getting paid, because there are massive payout frequency differences between the two.
Walk me through it.
In futures, they generally pay out daily to biweekly. You hit your profit target, you request the withdrawal, and it hits your account relatively fast.
Okay, that sounds normal.
The infrastructure is built for rapid disbursement, but in Forex, let's look at a massive firm like FTMO. They start you at an 80% split, increasing to 90%.
Right.
They pay rently or biweekly, but only after the initial withdrawal.
What do you mean after the initial withdrawal?
The initial withdrawals in Forex prop firms are often subject to 7 to 30-day delays.
30 days.
Yes, you pass the grueling challenge, you finally make a real profit on live funds, then you have to sit on your hands and wait up to a month to legally withdraw your first dollar.
Are you kidding me? A full month. Okay, let me just look at the psychology of this.
It's tough.
Is that delay designed entirely so a trader gets bored, over leverages with that 1.50 magnifying glass we talked about, and blows their account before they can legally withdraw the money they already earned?
That is a very dark way to look at it.
Honestly, tell me I'm wrong. Picture it. You have a 20-something sitting alone in their apartment staring at charts. They just made 5 grand. It is the most money they've ever made in a week. The firm says, great job, you can have this in 30 days. In the meantime, feel free to keep trading your funded account with your massive leverage.
Yeah.
They get bored, they get greedy. They think, I could double that 5K to 10K before the month is over. They take a stupid, highly leveraged trade, the account blows up, and the firm never has to pay out a single cent.
It is a known, documented psychological trap in prop trading. The friction of the payout window absolutely causes overtrading.
I knew it.
People get anxious. They can't just sit on a winning account and do nothing for 3 weeks. They force trades that aren't there and they lose it all.
It is a psychological test. It has nothing to do with trading skill at that point. It is an impulse control test. And if you fail it, they keep your money.
It is brutal. But we need to do the final math on all of this because I actually ran the net payout differences for a realistic high-level scenario to see which side actually wins once you strip away the marketing.
I want to hear this.
Let's take an aggressive scenario. You have a $100,000 account. You pull a massive 15% return in 1 month. That is $15,000 in gross profit.
Great month.
Let's calculate the Forex net payout first. You made $15,000. The firm takes their 10% split, leaving you with $13,500.
Okay.
You subtract the cost of your original challenge fee, let's say $110.
Yep.
Your final take-home net is $13,390.
Okay. $13,390 in my pocket.
Now let's calculate the exact same performance in futures. You made $15,000. But first, you have to deduct that pesky CME data fee we talked about.
The $135.
Let's call it $135. That leaves you with $14,865. The firm takes their 10% split of that, leaving you with $13,378. You subtract your roughly $88 challenge fee. Your final take-home net is $13,290.
Wait. $13,390 in Forex versus $13,290 in futures. It is a $100 difference.
Is $100.
Yeah.
On a $15,000 profit month, the difference is statistically microscopic.
I'm going to scream. We have spent this entire deep dive arguing about which market is superior. You came in here hyping up 100% profit splits and $25,000 Forex ceilings, and the actual mathematical reality is that they pay out the exact same amount of money.
Once you factor in the data fees, the challenge fees, and the profit splits, the math equalizes almost perfectly. Honestly, for a 5% monthly return, the actual payout difference is almost nothing after fees. I completely walk back the premise of this episode.
Unbelievable.
The entire futures versus Forex debate is an illusion created by marketing departments.
So what is the actual metric then? If the money is the same at the end of the day, how is a listener supposed to choose a path?
It is about finding firms with highly transparent rules and a proven track record of actually paying people out. It is about ruthlessly minimizing your total cost of funding.
Right.
Your success depends infinitely more on not bleeding to death from $135 monthly data fees or blowing your account up with 1.50 leverage than it does on which specific asset class you click buy on.
Which means we can abandon the market debate entirely and look at the actual practical takeaways. Because if you are listening to this right now, the first thing you need to do is calculate your own specific TCF.
Exactly.
You have to look at the data fees, not just the challenge cost. That $26 Forex challenge looks incredible until you realize futures might charge you $135 a month. You have to sit down and realistically ask yourself, if it takes me 6 months to pass a challenge, what is my total out-of-pocket cost?
The math changes completely depending on your timeline. And second, you have to recognize that leverage is a weapon that firms can and will use against you.
Yep.
That 1.50 leverage ratio in Forex isn't a gift to help you succeed. It is a trapdoor. It amplifies your mistakes just as fast as your wins.
And third, the 30-day payout delay. If you go the Forex route and you hit your profit target, you have to pass the psychological test. Walk away from the computer.
Seriously, just walk away.
Do not trade out of boredom while you wait for the withdrawal window to open. Let the clock run out, take your money, and only then go back to the markets.
Preserve the capital. Honestly, the whole thing comes down to knowing your own personality.
Which is the provocative thought I want to leave you, the listener, with today. Look at your own trading history right now. Open your journal. Are you a high win rate grinder? Someone who takes small, consistent profits and needs strict structure to stop yourself from doing stupid things? Because if you are, futures, with its capped leverage and centralized data, might be exactly where you belong. Or are you a low win rate home run hitter? Someone who takes a lot of small losses, but knows exactly how to manage risk with high leverage to catch a massive trend. That should dictate your market. Let your personal psychology decide where you trade, not a shiny 100% split banner on some website.
Perfectly said. That is the entire ball game right there.
Yeah.
Anyway, that wraps it up for us today. Next time we are looking at... Wait, what are we looking at next time? The scaling plans.
Right. We are dissecting scaling plans and how they secretly reset your trailing drawdown. You know, the mechanism where the minimum account balance you need to maintain constantly rises behind you like water filling a room.
Oh, yeah.
You literally write the outline for it.
Right. The trailing drawdown resets, we're going to map exactly how firms use that rising water level to catch you clipping. That one is going to get incredibly messy.
Yeah.
Thanks for hanging out with us, guys. We will catch you next time.